I just had a great conversation with Peter Walker, who, if you're a founder, if you're in a startup game, you've 100% heard of this guy. Even if you don't recognize the name, you've probably seen like one of the reports that he's put out on LinkedIn. He's the head of insights at Carta. He has access to startup data that, frankly, nobody else has. And he slices and dices it in a way that's unlike what you see just about anywhere else. So we went through kind of what he's seeing in the numbers, in the data over the last quarter and over the last couple of years, especially coming off of the COVID highs, what that's meant for like pre-seed, seed, Series A funding, graduation rates from round to round. And we went through a bunch of tactical advice that you can use as a founder to get the most out of fundraising and lower your dilution as much as possible. Welcome to the Product Market Fit Show, brought to you by Mistral, a seed stage firm based in Canada. I'm Pablo. I'm a founder turned VC. My goal is to help early stage founders like you find product market fit. Peter, welcome to the show.
Pablo, thanks very much for having me, man. Happy to be here.
So, man, I'm looking forward to this. I mean, I've been following you on LinkedIn for a while. You always put out, I think, some of the best data that I've seen, at least on like in the startup world, and more than data, like a lot of like deeper insights. So I was thinking, let's do a bit of a kind of the State of the Union report, see what's going on in startup land from your perspective, because obviously with Carta, you have, frankly, probably the best like atomic level, unit level data that you can then build up from. So I know you put out kind of the Q2 report recently. Maybe let's just start there. Like, what were some of the main findings this time?
Yeah, so we do this report called the State of Private Markets every quarter, just kind of a review of everything that we know about happening within U.S. startups. And Carta does serve startups across the globe, but this sort of data set is going to be very U.S. specific, just so that if any international founders who are listening who are annoyed, apologies up front. But a couple things stand out from the last quarter. One, it's now been 3 quarters in a row where we've had an expansion in just total fundraising. So we aren't anywhere close to where we were in the boom times of 2021, but it does seem like things are getting slowly and steadily a little bit better every quarter in terms of total fundraising. So if you're a founder in between rounds and it's been a really struggling period, like hopefully there is some optimism on the horizon there. The other things that I would point to, this was actually probably the most optimistic I've been about the state of startups in a little while. So a couple points on that front. One, the number of down rounds is decreasing. So the share of all rounds on Carta that were down rounds, it peaked at like 1 out of every 4 rounds on Carta was a down round, which is obviously not where we want to be, way above historical average. And that really declined from Q1 to Q2. So from 24% to 17%, which is a big drop. Second point is that bridge rounds also declined outside of seed. And seed is its own little thing. You seed extension, seed plus, there's a lot of bridges and weird stuff going on in seed. But in later stages, bridge rounds declined across the board. And again, I think that just indicates that maybe venture capitalists are spending a little bit less time with current portfolio companies, trying to keep them afloat, and a little bit more time with making new bets on new companies, which is obviously good for the ecosystem as a whole. So I'm actually kind of cautiously optimistic about what's happening in startups, but I understand that maybe there are some founders listening in who are quite annoyed with that representation because it has been a difficult time.
Do you have insights on company shutdowns, bankruptcies, stuff?
Yeah,
like that?
I do. It's never a fun data set to go exploring in. But, when we look back to when all of this started really changing from boom times to difficult times was, interest rates changing in the beginning of 2022. So that's quite a ways away at this point, right? That's 2 years that we've been dealing with this. So you would expect that companies would have sort of made their choices. Either they did the pivot, they changed the business and they're moving forward, or they did those things and it's not working and they would have shut down. What we're seeing, though, is that a lot of companies made really significant changes to their business through layoffs, software spend, maybe even pivoting business models occasionally, all this kind of stuff. So they're still fighting, like they're still afloat and trying to make it work. And many of those won't end up actually working, but they're still on the path for it right now. So I think that if I looked at our shutdowns data, it's definitely still rising, but it's rising at a much slower pace than it was in 2023. So hopefully, again, that's an indication that we're getting somewhere close to the end of this shutdown wave.
And by the way, back to your earlier point, like on COVID, the way that we look at it is, COVID was really the exception. Because if you zoom out and you look at the 5 or 10-year view, it seems like basically straight up, line up and to the right at a certain slope. And COVID was just this bomb that came and went. Is that what you think?
I think that's I think that's a very instructive way to look at it, as in don't take the peak to trough as what reality is, ignore the peak and just go, from 2018, if you extend that line forward. The difference, though, is just in the quality of companies. I mean, you would know this better than I would even. The kinds of companies that are raising a seed or a Series A today are just materially further along in terms of whatever metric you want to judge them on, ARR, financial health, growth rates, et cetera, than many of those that were raising in 2021. So I just think that the competition for the best, quote unquote, the best VC deals remains really high because the underlying founders are incredibly high quality now.
I think one of the biggest questions I always get from founders, and this show's really mainly about early stage founders, so maybe we focus on pre-seed, seed,
Sure.
and Series A, is what's a typical pre-seed? What's a typical seed? What's great? What ARR should have? All these sort of things. So I don't know if you have the data right in front of you, but maybe we go through each one. You're a pre-seed founder, or you're thinking of raising a pre-seed. What stats should you have in the back of mind? What is typical revenue, if there's any, median? What's outlier, different terms that you're seeing?
Yeah. So on the financial side, so we actually at Carta, because we run the cap table, we don't have a ton of financial information. So some of the data that I'm going to talk about here isn't Carta data. It's just anecdotal from having a ton of conversations with people. But we can tell you exactly the good medians and valuations, et cetera, for valuations and round sizes. So pre-seed first. Lots of different definitions of what pre-seed actually means. In our world, the way that we think about pre-seed is anyone who's raising between, say, $500,000 and $2 million on a SAFE or a convertible. So if you're doing a price round, that's not really pre-seed. And by the way, if you're raising $500K on a price round, you should probably do that on SAFEs anyways. You're going to save a lot on legal costs for how big that round is. The median's right there. It's pretty easy to see in the data that if you're raising about $1 million on a SAFE, the median valuation cap on Carta is a 10 million val cap. So 10 million val cap, 1 million raised. So that's a 10% ownership stake for that SAFE investor in your business. And the other thing is that founders sometimes get really tripped up on SAFEs and they continue using them and expanding the valuation caps and all this kind of stuff. And then it comes time to convert them all, and it's a real headache and they own less of the business.
Well, let's just go on a tangent here for a second. We'll come back to this because I had this discussion with somebody else. It's funny, you look at this, the convertible debt evolution, because originally it was all price rounds and then it became convertible debt. Then it was this pre-money SAFE. And then the pre-money SAFE was really good for founders because you just got to stack SAFEs on top of each other and all the SAFE holders had to share that dilution. And then they got smarter at YC and they put out this post-money SAFE, which the funny thing for me on all that is because YC is the one that did that and branded it and everybody trusts YC, it just becomes the de facto standard. But I don't think that many founders appreciate just how dilutive stacking post-money SAFEs can be. It is great for me as an investor. I prefer, and I'm giving advice to the other side of the table, I would rather invest on a post-money SAFE because it includes all the dilution, not just from other fundraising, but from options, from everything is all baked in there. I know that if I put $1 million and 10 post on a post-money SAFE, I own 10%, no matter what happens. And all the dilution's on the founder. I don't know if you've had conversations with founders or have you seen this surprise and kind of sticker shock.
It is an epidemic. And you hit on the key point, which is the switch from pre to post money was not a founder-friendly thing. YC sometimes makes it sound as though that was in service of founders. And you can make some case that it is more transparent, it's more certainty, et cetera. But that is primarily in service of investors. Because as you mentioned, with the post-money SAFE, investors that invest on a following SAFE do not share in the dilution. So if you were to do all of this stuff on price rounds, those investors would have already begun getting diluted alongside the founders as new money comes in. If it's all on SAFEs, the founders and then eventually the employees are the ones who take that dilution when the price round happens. So SAFEs, this anti-dilution provision effectively that exists in post-money SAFEs is a real headache for founders, one. Two is a lot of founders feel as though SAFEs are almost free money at the very beginning because it feels like you're getting this cash and you're not even giving up equity yet. So it can feel really great and they overuse them. One of the things that we've seen, there are companies on Carta that have raised on upwards of 15 different post-money valuation caps. Now, that's an outlier. Obviously, that doesn't happen often, but quite a few companies are raising on 2 or 3 separate valuation caps. meaning that conversion will take some time when it comes to that first price round. So I love safes. They're great, but they're not great to continue to put off priced equity. You should use them once, maybe twice, and then don't be afraid of price rounds because they actually they clean the cap. They make everyone understand their ownership really succinctly. And then everyone shares in the dilution of the following fundraise.
The piece you said about anti-dilution, I think is great because like, I can only imagine if I'm like talking to a pre-seed or seed stage founder and I'm like, okay, let's do a priced round, 10 money post. And I want like complete anti-dilution, not weighted, none of that stuff. Like the next round's roll order, I'm getting that next price. They'd be like,
no way.
But that actually would, right? Like you're nuts. But post-money safe not only has that, it also protects me against other dilution from other money you're going to raise, from any options you're going to grant beyond what's already in the ESOP.
The simplicity of it belies the value that it brings to investors, I think, a lot of the time, because investors can rightly point to that for founders and say, look, this is the easiest, most convenient, simplest way for you to raise cash. And founders who are not that interested in, they want to build their business, not spend all their time fundraising, they go, great, that sounds awesome. I'll use that. And it is just like, YC doesn't even offer the pre-money safe on their site anymore. We do through Carta. You can do pre or post-money. But if you use pre, you should expect your investors to push back on that because they've become accustomed to post-money as the default mechanism here.
I think that's right. And I think, the worst case, maybe you do one post-money, and if you find yourself fundraising again, then you try to do pre-money safe. But it's certainly a battle worth fighting. Okay, so that's helpful. So going back to it, 1 on 10, that's kind of the median pre-seed. One other question I had as we go through this analysis, we always see a huge premium for certain things. So today, in terms of sectors, AI gets a huge premium. And the other one that's consistently gone a big premium is like repeat founders, especially those who have had like previous success. Do you have any insight on what that does?
Yeah, it's a major impact. So if you look at like just take SaaS versus AI SaaS, so like non-AI versus AI, but in the single SaaS enterprise category, on that same valuation cap basis for a pre-seed round, the AI might be, 1 million on 12, 1 million on 13 as the val cap versus 1 million on 9 or 10 for the core SaaS. And you see that across the stages. At seed, AI is valued more highly and the rounds are a little bit bigger. At Series A, AI is valued more highly and the rounds are a little bit bigger. What I will note is that there are distinctions starting to happen within AI itself. So there are some dev tools and foundational stuff that continues to be like rocket level, super high. Evaluations are pretty, 2021 level boom times. And then there are parts of AI, maybe you call them AI-enabled startups. AI is more a part of the tech stack than it is the reason for being for this company. And those are kind of falling a little bit back towards the medians that we see at the regular sector level. And so I do think that while AI is definitely still the hype cycle, investors have gotten a little bit more sophisticated about what, quote unquote, qualifies as a real AI company. Not to say that it isn't showing up in every pitch deck, because I'm sure it is.
Okay, but to the extent that you are real AI or can brand as such, it's probably a 30 to 40% premium.
I think that's a good way to think about it, yes.
And what about the first time to repeat founder? Because that's one that often gets lost, because when founders will look at comps, they'll just look at, well, here's another company that's in a similar sector at a similar stage as what they raised. They forget who's behind that company, and that's always a huge...
It's a giant deal. You're right to say that we don't have great data on whether or not you're a repeat founder or a first-time founder. I will say that when we speak to investors, or even when we speak to founders, this is one of the points that is potentially the most upsetting. It's because it could be that this repeat founder is fundraising in a similar space as you, but has no traction. They might not even have a product. And you come in and you're like, I have traction, a product, customer list, etc. And this person is getting a much higher valuation.
Yeah. And I think, look, the way that we look at it is if I can take less risk on a founder because the founder has already proven themselves in a past venture, then I allow myself to take more risk on the market or the market opportunity, the traction and sort of thing. So those risks can kind of be traded for one another. And frankly, there's a lot of data that supports this. There's this book that you're probably familiar with called Super Founders. Looks at repeat founders who've sold a business for $10 million or more, and they're 6 times more likely than first-time founders to create a unicorn. So when you factor all that stuff in, that's the reason for those differences. Okay, so that anecdotally, what are you seeing in terms of revenue?
Yeah, so there are people that are investing at pre-seed, pre-revenue. That does happen. I think it happens a lot less than it used to. It's seed, you might be talking about $1 million in ARR, maybe a little bit less. And again, most of these data that I go out and talk about is is primarily like enterprise SaaS. There's a lot of different models for different kinds of sectors. So
okay. And so moving on to seed, then what's a typical
seed round? So seed can happen either on safes or in priced equity. It's kind of 50-50 muddy middle now. We only include seed. We only call around a seed round on safes if it's for $2 million or more dollars. Okay. One of the advantages of being the system of record here is that we can split out really easily primaries versus bridges and extensions. So because we see that actual information, we know if you'd already raised a seed, that this is a seed 2, a seed plus, et cetera, and we can remove those from the medians. So it's not getting too messy. So for seed on Carta today, the median amount raised is about 3 to 3.5 million. And the median valuation, this is a pre-money valuation, is 14. So if you add those up, that's, call it 17 million post or so, 17 to 18 million.
So the lift for an investor is not a lot, right?
So I love your opinion on this. When an investor is making an investment into a pre-seed company, and obviously that's happening on a safe with a valuation cap, are they expecting that the first price round is going to come in double that val cap?
I go into it, let's call it hoping or expecting, right, that it's a double just because of the risk. Like I think to myself, a lot of these pre-seed rounds that we're getting into is like, depending on the type of founder, it's a proven repeat founder, it's pre-revenue, pre-anything. And if it's like a first-time founder, maybe it's going to be like 10, 20K of MRR, a handful of customers. The difference between that and your $1 million company that has like potentially 100 customers or 15, 20 customers, depending on the ACV, is material. Like you can call a lot of different customers, get a lot of reference points. You have actual data on growth rates. And so for you to only get like a 30 or 40% markup, if I have the choice, I'm like, well, I'll just wait for that. Seed round. So that's kind of how I think about it is like, if I'm going to come in at 10 post, I'm really hoping your next round is like 18, if not like realistically 20 or above, but okay, fine, 18, 17, okay. But I think it's like, what is the conversion rate and the time between pre-seeds and seeds?
It's gotten way more messy because of the rolling nature of fundraising on safes. In general, though, what we've seen is that the time between a seed and an A it used to be the standard of advice was 18 to 24 months. The median is now over 24 months. It's over 2 years. So it will take longer than you think. That's the number one piece of advice that I can give founders right now is from the data, 18 to 24 months is out of date. It's more like 24 to 30, even.
That's from seed to A.
From pre-seed to seed, it's quicker. We're talking in the 18-month range, but it's happening. Some are happening super fast. I mean, within like 6 months. And some are happening, 3 years from now. There's a wide distribution between pre-seed and seed.
Okay, let's call it 18 months between pre-seed and seed-ish on average, and 24 plus, which is definitely, that's a change for sure, because we were talking about 12 to 18. So, okay, 24 plus seed to A. What about the conversion rates?
We have great sort of data on we call them graduation rates. But the interesting part there is obviously those have been deeply impacted by the just general change in the macro for startups. So if you slice it out by cohort, so each of these cohorts, we can discuss them as a group of companies that raised their seed round in a given quarter. In this case, we can look at, say, companies that raised their seed round in Q1 or Q2 of 2020. Something like 40% of them had gotten to a Series A within 2 years, which is a really, really high graduation rate. Usually the entire graduation rate from a cohort is something like 50%, not within 2 years, just total. How many of them get passed from their seed round to the A round at all? It's about 50%, give or take. So 40% doing it in under 2 years in 2020 is like wildly fast. Money was cheap. That was the good times. Graduation rates for recent cohorts that have just passed their 2-year mark. So in this case, we can talk about this as, companies that raised their seed round in, say, Q2 of 2022. And then, so that was right at the tail end of the party before the punch bowl got taken away. And now they're dealing with this whole, shenanigans since then. If you look at the 2-year mark for those companies, only 15% have made it to A in 2 years. So it's a gigantic gap, right? It's a gigantic gap. It's one of the things that drives home is there are so many external factors that impact whether or not a founder is successful. Timing is obviously the first one of them, and timing takes into account this sort of macro conditions. But that applies to VC funds as well. This is why investing in one vintage it's probably not going to do very well because you're putting a ton at risk in that individual vintage, just based on whatever the heck is happening in the wider economy. So that's the graduation from seed to A. From pre-seed to seed, I would probably imagine that it's something similar. It's kind of tough to say given there's a lot more companies trying for pre-seed. So maybe it's actually a little bit lower, but 50% is the standard mark that we usually see.
Well, so just back to your earlier point, I mean, if you think about it from an investor perspective and you say, okay, the median pre-seed to seed time is 18 months. And let's take the 50% graduation rate. And then you say, okay, and the median lift is only 40%. So you get a 40% return median in 18 months. So whatever, that's like 25% return a year, let's say, ish. Only on half of them. And so like we're really talking about like a 12% annual return. Nothing there sounds like venture to me, at least in terms of that kind of pre-seed to seed piece.
I kind of agree. I think that there's a lot of skipping that's happening. So from like pre-seed to Series A size rounds, et cetera. So that does happen with the best companies. But to your point, I mean, I think that the risk-adjusted returns for a lot of recent fund vintages are going to be pretty low because this is just not like an environment where it's very easy. And you see some investors trying to change strategy based on that. I mean, most of the strategy is obviously dictated by the check size that they can write. So it's not like they can go be Series A investors when they raised a $20 million fund. It just doesn't, the math doesn't work that way. They can't make enough investments. So you're kind of stuck a little bit in the part of the market in which you fundraised for your fund. But some of them have dramatically reduced the amount of investment that they're doing. They're deploying capital more slowly. There may be, opportunities or suggested opportunities to founders that like, hey, maybe this strategic acquisition is actually a really good idea so I can return a little capital to my LPs. All of that stuff is happening as a background.
And so let's go to that Series A piece just to finish this part of the storyline. What are you seeing? You said 2 to 3 million generally in terms of revenue. What kind of a round does that get you?
So the median cash on a Series A round is $10 million for our US startups. And then the median valuation pre-money is 40 or 41. So post-money, that's a $50 million valuation for Series A. So that's a significant jump up. I think this part of the market, the jump between seed and A, is the biggest chasm right now in startup world. There are just so many companies that are in the seed plus, pre-A world.
I think that's correct. I remember even a decade ago them talking about that Series A gap and just being so hard. In general, pre-seed and seed, there's still so much of a narrative that's part of it. And so finding some investor somewhere that will kind of believe what you believe is just a lower bar than getting to $3 million in revenue. And with the sort of growth rate, like it's not going to be 20% a year growth. It's probably going to be 100% on average. I'm sure some higher, some a bit lower, but that's just very hard to do. And the bar's really high. And it gets you a very high, like 40 million. That's pre-money valuation. So it's a 40 million pre-money, $10 million. Like it's just a big lift to go from 3.5 at 18 post to 40 pre and $10 million. So it actually kind of makes sense.
That checkpoint is where some of the venture math starts being more rational to me, even with the valuation declines that we've seen at the later stages. 40 million for a pre-money for a Series A, up to like, call it, I don't know, between 100 and 110 million for a Series B. Like now you're seeing the gaps between these, the markups make sense for those early stage investors. I agree with you. The messiness around pre-seed and seed, there may be some decline in the value to many investors there.
But how common then is like a seed plus or seed extension? Like should a founder almost assume like, hey, odds adjusted, if I raise a seed, like I'm probably raising a second seed before, just like when you raise a pre-seed, you assume I'll raise a seed before an A. You raise a seed, you're like, I'll probably raise seed plus before an A.
I mean, it's a huge portion of the markets of the priced seed rounds that happened on Carta last quarter. 42% of them were actually extensions or bridges or seed plus. So that's a ton, right? Now this is above historical average, and we are seeing that number dip down a little bit. So which is, I think, good. As an investor, you don't want to have to bridge every one of your companies. That doesn't make sense. But it is a much more common part of the early stage fundraising journey, which has significant impacts to the dilution that those founders are taking on. Because dilution in a standard seed round is still right around 20%. for a founder. But if you do the bridge, that might be another 8 or 9%. And then you're talking about having done 30% in your seed. And that's a very high diluted figure if you're trying to get all the way through the alphabet rounds.
Do you know what percent? I just assume you have like all the data at your fingertips. So
I like it. No, that's right.
Just like asking for all these data points. But do you know what percent of companies that have raised a seed round also raised a seed extension? Like you said, 42% of seed rounds were seed extensions. But if I'm a founder and I'm thinking about what are my odds of having to raise a seed extension?
Over the last 2 years, I think it's like just over a third. So that's quite high, but it's not everyone. And just for more founder advice here, typically, although not always, but very common, the people who are going to be giving you that seed extension are already on the cap table. Right? It's mostly led by insiders who are already investors in your company, and then maybe filled out by some new external investors.
Interesting. I always wonder if that's like a new, like seed stage investing as like a category. It wasn't really a thing a decade ago. I wonder if seed plus investing as a category becomes a thing.
It's actually maybe a deeper point than you're making there, which is that venture as an asset class is getting more professionalized, right? And as that happens, there are subsegments within the venture ecosystem that become more standardized. And then it feels as though it's a little bit less Wild West and more you venture companies hit standard checkpoints. That strikes me as something that will happen just by the nature of how much money is devoted to this asset class now. I'm not sure if that's always a good thing. I don't know if like having all of these little sub-segmented slivers is good or bad generally for the ecosystem.
Like, what would be the bad?
Bad argument is that it makes founders think that they can't skip. So it's like you actually don't need to follow that path at all. Some of the best companies, let's take Figma for an example. They were pre-revenue, pre-product, like building this thing for 3 years, then had a big A round, and then we're off to the races. Like there's other ways to do it where you jump around. It's not like you have to follow the standard alphabet path.
Well, I think that's a great point, but maybe having more of these slivers, like in an ideal world, at least from the founder perspective, it's like, here's where I'm at, here's what I'm raising, call what you want to call it, like who's interested.
Totally.
You know what I mean? Like versus, oh, well, that's not really quite a Series A, so no. And they're like, well, that's too late for a seed, so no. And you're in like this weird no man's land, even though you actually have like more than you did at seed. And so you would think risk adjusted, it's a better profile.
I agree. Maybe that's a better way to say it is like, if you as a founder have a strong, thoughtful case as to, I need this amount of money to execute on these things, then the name of the round, it only matters insofar as to finding the right people. It's not actually important to know.
So let's jump to another kind of area. We talked a lot about kind of fundraisings and rounds. The other thing you have a lot of data on is like the equity splits. The equity splits, obviously with founders and investors, but also with employees. So I'm not sure what you're seeing there, but that would be interesting. I think, from a founder's perspective, the big questions are around what is right. Because like, everybody takes a different funding journey, but then you zoom out and you're like, okay, this is what I own and this is where I'm at. Like, am I good? Am I not good? And also for the employee side, like what should I be giving depending on the role? So, things you have on that.
Absolutely. Yeah. So I think we have absolutely fantastic data in this segment. Let's take a step back for a second before I jump into the founder side and just talk a little bit about how hiring is trending across startups, because this has been one of the follow-on effects that we talk about it, but we mostly only talk about it in terms of layoffs. Right? Layoffs get headlines and that sucks. And everyone that from Google on down, like there's been a wave of layoffs through private tech and big tech. But when you get into the hiring for startups, put some numbers around this, 45,000 US startups on Carta. In the beginning of 2022, collectively, those companies hired nearly 60,000 people net of the people they lost. So 60,000 more people than the people who left their companies. Huge month of hiring. Everyone was growing super fast. Headcount was really important to show off, et cetera. Like that was happening. In recent months, the last, let's call it 9, 12 months, basically net headcount changes on Carta is effectively flat, meaning they're not hiring. They're really maybe replacing the people who left, but they're not hiring a ton. And that lack of hiring is the primary dynamic that goes into how much people are paid, because there's a ton of great talent on the market right now. And so even though inflation is high and all of these things, startup salaries have basically remained flat over the last 18 months. And startup equity packages are actually down over that same period because the supply and demand dynamic, there's just not as many people being hired. There's a ton of great people that are out there looking for a job. So that's the sort of like broad context under which we can talk about founder shares, equity for early employees, et cetera. Let's talk about founder equity to start with. So yeah, we get a ton of questions on this, as you can imagine. At the very earliest stages, I think there's a couple things that are pretty clear. First off, we did this analysis of 7,000 companies, and we looked at how did the founders split equity before any fundraising, before any team, just the founding team. How did they split up that pie amongst themselves? The first thing that we found, which is perhaps contrary to most people's assumptions, is that most of them do not split equally. The standard thing that you hear from many accelerators and other people in the Valley, but something like 58% of two founder teams split unequally. So not 50-50 somehow. It wasn't a huge gap from 50-50. You know, the median split is something like 55-45, but they did do something other than 50-50 straight up. And then you can imagine if you have 3 or 4 or 5 co-founders, like splitting 20-20-20-20-20 doesn't make a lot of sense. There's usually some differences in how you split equity there. So that was the first finding. The second finding is that we also looked into how did they pay their earliest employees in equity. And there's a couple interesting points there. The first one is we have some data on, hires number 1 through hire number 10, how much equity they get. On a median basis, the first hire at a startup, the median is about 1% of the company. But there's a huge range. So it might be 0.5%, it might be 4%, 5%, depending on who that person is. If they're a technical hire and it's a non-technical founding team, that person generally gets a little bit more equity. If the reverse is true, then maybe it's a little bit less. So a lot of range, but 1% is the median for first hires. And then the biggest finding is that just falls off super quickly. Hire number 8 might get like 0.2%, maybe 0.15%. And if you think about it, I think that's actually perhaps the most difficult risk-adjusted bet in startups is being employee number 8 or 10 or 15, in that you're taking on a ton of risk, but you are not being compensated for that risk with equity in the same way that the founders and the earliest employees are. Not to say you should be equal. The founders are taking on more risk than you are for sure, but you are betting a portion of your career there, and that equity value that you get is perhaps not quite, it's not necessarily relative too much to the risk that you're taking on. So maybe that's a little bit of an explanation of like the earliest part of the hiring journey.
It's true. Like if you're that like employee number 10 or 15, your risk feels lower than the founder, but it isn't, because if the company goes bankrupt, you're out. And if the company doesn't go bankrupt, but goes through really hard times, you also might be out. Whereas the founder, probably wouldn't. And so you have like that risk on the downside. Your pay is probably not going to be market unless the company's exceptionally well funded. And then it's like, you think about the risk reward, like if this is truly an outlier, like in $1 billion plus outcome, yeah, you're going to get rewarded. But if this is even like a successful $100 million, $200 million exit, and you do the math, net of dilution.
We talk to early employees a lot about this. And my number one point is, if your goal is to reliably make the most amount of money, early stage startups are not it. Like on a risk adjusted basis, that's not a great bet. I was employee number, 11 or 12 at a startup. Like I wouldn't trade that experience for anything, but I didn't make a lot of money out of that. I learned so much, because you're actually wearing 100 different hats and you're responsible for things that you would never be responsible for at a big company, but you have to find smart people to do a thing. And that thing is always new and always exciting. So there are amazing reasons to join early stage startups, but doing it specifically because you think that equity is going to be worth a ton is actually not a great.
Yeah, that's a great point. It's a career accelerant. It's a way to have impact. It's certainly fun, but yeah, not necessarily the biggest amount of dollars for it. Okay, so what about like just ESOP pools, like in general, like
ESOPs for pre-seed companies on Carta started about 10%. This is actually something that we hear occasionally founders get pushback on from VCs, and I don't really understand it. Like some VCs push for a much bigger pool. I mean, I guess I do understand it because they would not be diluting themselves. But, at the earliest stages, it's 10%. And then as you fundraise, as your valuation grows, the median ESOP also grows. And this makes sense because as you come up to your Series A fundraise, you'll have discussions with your investors saying, look, we think in order to fuel the growth of the company, we need X, Y, or Z roles. We think we can get those people for this much equity. So we need to expand the pool by this much. Once you get to about a unicorn, it's about 20%, 19 to 20% of the company reserved for employees. And then at IPO, it's maybe 21 or 22-ish. So it goes from 10 to 20, but it only grows pretty slowly as you do.
What about founder ownership? That's one thing we tend to look at. Like, there's a point at which we don't care, but there's a threshold where it's like, I've seen founders raising a seed round, but it's not the first seed round, obviously, but they're like at 15% or like sub 20. That's challenging. It's really risky for us. Like, I have multiple, because I'm like, the founder's always going to be motivated, even if they own a small percent, but I'm also like, who is this really? This company is like 80% somebody else.
Definitely. And I think that many great VCs think the same way that you do, which is like, it is actually very important for us to have a founder be properly incentivized to the long term of this business, because especially at the earliest stages, that's what we're doing. We're betting on you. So you need to have a significant portion of equity. We still hear the general rule of founders are trying to hold on to, a majority or close to a majority of equity once they exit the Series A raise. So post the Series A raise, does the founding team as a whole own 51% or more? That's still a benchmark that I hear thrown around a lot. I will say that there are many, many teams who do not hit that benchmark. So it's not like an unquestioned, threshold that you can't miss. In general, though, if you look at the dilution per round, you're talking 10% in a pre-seed, you're talking 20% in a seed, and 20% again in your Series A. Those are the median dilution marks. And then you throw
plus anything in between.
Plus ESOP, right? Which is like, again, if we're thinking about this gets back to our earlier conversation, which is if you do this all on safes that's coming out of you only, you don't want to do 3 or 4 rounds on safes and big money and then take on all that dilution for your first price. So like, have the investors in the price round take some dilution along with you. Because it definitely can add up pretty quickly.
Okay. And then maybe just to end on this, we talk about dilution, and I often talk about a lot of these founders that I've interviewed on the show that have gone on to be, unicorns or close to it, have raised like really small rounds. They bootstrap at the beginning, but I saw post the years that got a lot of traction talking about not raising a small seed round. What's the point of driving it there?
People had really strong feelings about this post. The general gist of it was that if you raise a small seed round, that is less highly correlated with your ability to raise an A round. So it looks to be that the smallest, and there's a bell curve here where, at the smallest seed rounds tend to make it to A. The companies that do so tend to make it to A less frequently, but the biggest seed rounds don't have like some sort of magical, meaningful impact on the A's. It kind of levels off. So what are the key actual takeaways there? It's not that raising a tiny seed round is in all cases bad. What it is that probably what the data is showing is that the founders for whom it's only possible to raise a very small round are probably less well positioned to make it to the A in the first place. So there's a little bit of, chicken or egg in that data. But I do think it matters for founders to take a look at, for instance, the timelines between rounds and realize if you sell 15 to 20% of your company for $1 million, 2 things happen. 1, that's a pretty low valuation for your company. But 2, you have to get to the next round with only $1 million. And that can be really hard. And then if you come back to the same investors, they're probably going to demand more equity if they're going to fundraise or help you fundraise again. So too little upfront can it make it really hard. You're butting up against those timelines really, really tightly.
That makes sense. And I think the other thing that's probably baked into that correlation is just, besides the likelihood of the company itself to make the Series A, is the ability of the founder to fundraise. I mean, generally speaking, those who are great at fundraising tend to raise more. That's true for a seed, and that's true for a Series A. And honestly, it's a big part of who ends up closing money. Like, as much as the numbers definitely matter, and they start to matter more, like certainly by the time you go public, like it's going to be a lot about the numbers, no matter how good of a storyteller you are. But in a pre-seed, it's all about the story. And so that kind of, that kind of trade one for the other as you move through your stages.
I think that's very well said. And there's also, to your point, there are a lot of companies that are just kind of looking at venture as a whole and saying, maybe I do that down the road, right? Maybe I try to bootstrap this into something that's a little bit more of a bigger business. And then I actually only take on external capital when I feel like I'm ready to pour fuel on the fire really deeply. That's an amazing path if you can take it a lot of founders are experimenting with either not taking venture at all, or maybe 1 or 2 rounds of venture and then get off. There's like a diversity of models. I think they're going to pop up. We'll see if LPs want to fund all of those models. But I think on the founder side, I think it makes sense to like, what is this business really? And try to right-size your fundraising to what you think this business really is.
Yes, 100%. Cool. Well, Peter, it's been amazing having you on the show. You have tons of data clearly. And I think, a lot of this is really illuminating for founders because as a founder, like first of all, you don't have the time to like go through and read all these reports most of the time until like it really matters and you read it and then it's too late. So what you see mainly is like the headlines, the TechCrunch, this person raised this, and it tends to be like the outlier stuff that comes out.
I love it, man. Yeah. And not to say that you don't need to raise the median round because it's the median round, but it's good to walk in with conversations with VCs feeling like you understand the market. So that's our whole goal.